Hello, everyone. Welcome to another lovely episode with JForex House. I'm your host, JFX, and this is the episode 6 of our Elliott Wave Mentorship. All right, so this is a live analysis of US 30. Like I said in the previous episodes, I use Elliott Wave for higher time frames. I barely use them for lower time frames. So this is a breakdown of US 30 on the 15th of January 2025. Okay, so this is my insight for what I think might, play out in the coming days, because from observation, we had a previous bullish uh, movement, which, as you can see from here, it met all the criteria as necessary to be a bullish wave. Okay, as you can see, wave 3 is not the shortest. Wave 4 did not intertwine with the wave of wave 1. And also, we are currently in a corrective phase where we are seeing a retracement of the first leg, expecting a wave B before a wave C. And over here, we have a resistance level which happens to match up with the Fibonacci level of 61.8, okay, which happens to be a key level when it comes to Elliott wave. We're going to understand more about that in our episode 8 and 9, all right? So on this episode, mainly we're going to be talking about the impulsive wave, but I just decided to give you guys an insight because I'm about to share this to the Telegram community. If you're not in the Telegram community, the link is in the description. You can join that and also have chats from numerous traders from around the world who share analysis using different concepts, okay? So this is projected in form of an impulsive wave because I'm expecting a zigzag formation from this, okay, to complete the overall narrative of this impulsive structure. So I'm bullish on this pair, but we're currently in a corrective phase. So that's my analysis for US 30 daily time frame using Elliott wave method. Okay, so let's go to the topic for the day. We are talking about impulsive waves. I'm about to share um, a screen from our ebook, which the ebook about the core principles of Elliott wave from multiple concepts and research. Okay, so this ebook is available for free. It's within the Telegram community. You can also get that for free. So the link is also in the description. And on chapter 4, we talked about the two major primary wave structures that form the Elliott wave pattern, which is what I showed you earlier on the chart using US 30. We have the 1, 2, 3, 4, 5, which happens to be the impulsive pattern, okay? And then we have the ABC, which happens to be the retracement pattern, all right? So this is basically the primary concept of Elliott wave, and it helps you to understand what is going on within market structure, all right? So market structure is not a concept that is neglected by Elliott wave. Market structure is highly respected by Elliott wave with core principles that could help you identify which area of interest you should pay attention to. So the impulsive wave, okay, is breaking down what happens on the trend, while the corrective wave is breaking down what happens on a retracement. So market structure is no way neglected by Elliott wave. Market structure is very important, and you have to also understand the basic concept of market structure, which is highs and lows, higher highs, lower lows, stuff like that, before you can take a basic mentorship on Elliott wave, because you have to know what we're talking about. On these aspects, we are viewing them with alphabets and numbers, not highs, lows, higher high, lower low. So that also you have to know before you are able to understand what we're doing in the chart, okay? So if you don't have that concept, go look for a series within the YouTube channel that talks about market structure, and then you can help get yourself educated so you can get yourself to this point where we are right now. All right, so on this impulsive wave, like I told you guys in episode 3, where we talked about the general concepts behind all wave patterns, the impulsive wave is also viewed in a bearish structure. So there's also a bearish impulsive wave. Also, you view it with the 1, 2, 3, 4, 5. I told you guys the wave 2 and wave 4 are corrective waves. Wave 2 and wave 4 are corrective waves because, as you all know, markets move in a rhythm. So this is impulsive retracement, impulsive retracement, impulsive retracement, and that's what we call a bullish trend. And then we have impulsive retracement, same pattern, but this is called a bearish trend, right? Now, on each side, we all have retracements. So retracement is necessary for the trend to exist because the trend has to follow market structure. It has to have a structure. So the retracement is viewed by A, B, C, and the impulsive moves are viewed by 1, 2, 3, 4, 5. This also means on this aspect, this would still be a lower time frame 1, 2, 3, 4, 5. This would also be a lower time frame 1, 2, 3, 4, 5, and this would also be a lower time frame 1, 2, 3, 4, 5. Okay, this would also be a lower time frame 1, 2, 3, 4, 5. Same goes for this, and then same goes for this, and then this as well. While on the other hand, we would have an ABC around this point, ABC around this point, ABC, same goes for these same areas as well. So as you can see, Elliott wave is primarily formed by these particular patterns. Now, in situations where we have complex retracements and consolidations, for example, when it comes to decision points like this, so you might see a rough structure where it's difficult to understand what's going on. Basically, the aspect of technical analysis where Wyckoff is very, very useful, which we also have a series on Wyckoff method. If you're new to the channel, you can go check that out. So you can also understand how to use Wyckoff method in complex situations like over reversals levels and a trend changing from one hand to the other. Okay, so there's a series on Wyckoff that also covers that within the YouTube channel. So when we get to episode 9 and episode 8, we'll also be talking about complex corrective structures like what we have here on the ABCDE, or what we have here on the WXY. Okay, so these are two complex corrective structures which I emphasize on mainly. There are other patterns as well, but I like to use this too because it's basically something that helps in terms of understanding complex structures. And then you can also use it to form other complex structures which you can think of. So it's not necessary for you to have all patterns in your head unless it becomes difficult to know what you're doing. As you can see, 1, 2, 3, 4, 5, and ABCD basically explains structures to the fullest. And on consolidation range, you're expected to not even be in the market. So I don't even see reasons why you should pay more attention to the complex patterns, which can get you confused easily. Okay. So pay attention to the 1, 2, 3, 4, 5 and the ABC, and then you will be good to go. Using Elliott wave would be as a piece of cake for you, same way I'm breaking it down right now. Okay. So when it comes to the 1, 2, 3, 4, 5, again, this ebook is available within the Telegram community. So you can also go get the ebook so you can do your studies yourself. And then you can come back to the series and understand what we are doing. And on the beginning of this episode, I gave you guys insights using 1, 2, 3, 4, 5 and ABC. So we're going to go back to that after this breakdown. I just want you guys to have these insights, and also you can pause the screen, read what is on the screen. You don't expect me to do that. And you can also have insights to what we are talking about basically by reading what we are displaying on the screen too. So we are currently in a position that we can identify with this pattern. Okay. So on the analysis I made, I told you guys we're expecting a retracement into a quasi-modal level of wave 5 and to form the wave B retracement of the bullish trend, because I believe US30 is bullish on the daily time frame. And then we're expecting a bearish leg to mitigate the 61 Fibonacci level of this previous range to form the wave, probably wave 4, or we could say wave 2 of an even higher time frame. Okay, so depending on what the weekly time frame is saying, like what you have over here. So this could be the same thing, just depending on the perspective and the time frame you're on. So on a lower time frame, you could identify these points as where we are on. And on the higher time frame, we could identify these points. As you can see, this B is bigger than this one, but they are both having the same information, just on different time frames. Okay, so the 1, 2, 3, 4, 5 is an impulsive wave pattern that helps you understand the trend. There are bearish ones and there are bullish ones. And every retracement is an ABCD pattern. Okay, so let's go back to the chart where we had the breakdown earlier. All right, so back to the chart. Over here, you can see from the analysis, I'm expecting um, a retracement. Okay, so this level we have here is a complex retracement level. This is a consultation level, so there's no major direction. I could break that down with a complex wave pattern, but I decided to leave that out to not make things too complex. But as you can see with the blue dots, I'm still keeping to the rules of market structure. And from this point, if we could draw as simple as a triangle, okay, to give you insights, you would understand that the major trend started from this low, which never got invalidated over here. Okay, so this is my reason for picking this and then picking this as wave one and this as wave two retracement. As you can see, it never went below this. Okay, it never went below this. So this counts for wave two. And then wave two heads on to create an impulsive wave, which we can identify from here as 1, 2, 3, 4, and 5 to give us insight to what's going on wave 3. Remember what I said earlier? Wave um, 3 is an impulsive wave. Okay, so it has to be formed with an impulsive wave. And then wave 4 is a corrective wave, so it has to be formed with a corrective structure. Okay, and sometimes the candlesticks is difficult to understand the structure. Don't forget what we had on the ebook were line charts. Okay, so you can easily see an A, B, C over here forming wave 2. So that's because wave 2 is also what? A corrective wave. So we can say this is what is going on the lower time frame that forms this higher time frame pattern that we can see with our eyes on the daily time frame. Okay, so let me take this out so you don't get confused. I made the analysis as simple as possible from the beginning, right? So as we break down to an even complex system, you don't get confused. Okay, so now looking at this, you understand more about how I got my insights, why I pick my zones, and what's going on over here. Okay, so now we say this is wave 4. You can see 1, 2, sorry, A, B, C. That's wave 4. Don't identify that because it's very, very small. But wave 4 was not supposed to go below this, which is the territory of wave 1, right? That's one of the rules we use in identifying a wave 4, one of the major rules. And what do we have here? It did not actually go below the line. So that counts for wave 4, okay? So it's not basically how the structure is formed alone that counts for what gives to what classifies a zone as this certain wave or this certain wave. It's actually the rules and regulation which are also stated in the ebook. So you can get the ebook from the community so you can study properly and also have an insight to how this whole system works. Okay, now coming to wave 5, you can also see a similar structure, but you can see something like an A, B, C if we were to be more realistic. But at the same time, I told you guys we have more complex patterns. Same way we have more complex corrective patterns, we also have complex impulsive patterns as well, which wave 5 happens to be one of those aspects where complex patterns comes in. Wave 5 and wave 1, right? We'll talk about that more in future episodes. But for now, we're talking about a simple 1, 2, 3, 4, 5 pattern. So I'm not going to get you guys confused to explaining why this happens. But yes, sometimes you can have an ABC forming the wave 5. Okay. Now, after that, we then see an impulsive wave to form the first leg of the major retracement. Remember, I told you guys a zigzag pattern. You go to the ebook, we have what we call the zigzag pattern. And then on that zigzag pattern, we find wave A as impulsive, wave B as corrective, and wave C as impulsive. So this is like a zigzag. And then this looks like a zigzag pattern, right? Given with extra confluence, we have the Quasimodo formation over here, which is a confluence I use as well in understanding market structure. Like I told you guys, I don't care about the method I use. As long as my analysis goes my direction, I'm fine. Okay. At the same time, if you use SMC, you see this as liquidity, right? And we also see this as a demand level, right? So that gives insight to explain to you that this is a high probability setup of a higher time frame. As you can see, there's a Quasimodo pattern lining up with Elliott wave and also SMC lining up with this. So Elliott wave is very, very useful and also helps in spotting areas of interest at a very, very easy rate. These tools are already available for you on TradingView, and then you can also use them to practice yourself to see how good you can get understanding this method. Okay, so I wanted us to do a practical video of where we are using the impulsive wave mainly to break down structure so you can have an insight to that. So that is what episode 6 is all about, for you to understand how these concepts work, using them casually on the chart, just like how we did on episode 5, but this time around in a different perspective, coming from a bullish market again. Okay, that will be all for this episode. I'll see you in the next episode. If you're new, please like and subscribe. Leave a comment below, and for a topic you might like us to look into concerning smart money concepts, Elliott wave, whichever method you're into. And then you can join the Forex community, which the link is available in the description. See you next time. Bye.